morning and welcome to another episode of Always Up to Date. I'm Denise and this is Yahweh, and we are co-owners of Always Bookkeeping. How are you doing today, Yahweh?
Good. It's raining outside, but hey, it happens.
Better than snow, right?
Yeah.
So today we're going to be talking about T4s and T5s. Our quote for today is from Michael Gerber, who is the author of The E-Myth. So the fatal assumption is, if you understand the technical work of a business, you understand a business that does that technical work. So basically that means, just because you are a contractor doesn't mean you know how to run a contracting business. If you might be a dentist, doesn't necessarily mean you know the technicalities of running an actual dentist practice. So that's kind of where that fatal assumption might come in. And you can get yourself into trouble. Our statistic is kind of one of our favorite statistics that kind of keeps us going and makes us want to help small businesses to grow. And the statistic is that 50% of all businesses are out of business in 5 years, and 29% of these failed because failed businesses will cite that they ran out of cash. So again, like I said, that's kind of why we do what we do. We want to try to help these small businesses specifically to stay in business, so they're not part of that 50% statistic. Yeah. So lots of times we have business owners that they haven't filed T4s and T5s, or they haven't filed them properly, and that triggers a payroll audit for them. And so once a payroll audit is triggered, then CRA is going to start scrutinizing the rest of your records. So we want to try to avoid that. So Yahweh, there's a few questions that we just want to answer so that people kind of know a little bit more about filing their T4s and T5s.
For sure. First question you want to ask yourself, generally what amounts need to be recorded on T4s and T5s?
Yeah, good question. So the difference between, on the T4s and T5s is that T4s are your payroll deductions. So your taxes, your CPP, your EI for
your salary.
Your salary, yep, for yourself and for any employees that you have. T5s, that's going to record any dividends, so money that you've taken out of the corporation but isn't considered your salary.
What is the difference between T4s and T5? Yeah,
so we kind of discussed that above. The T4s are the salary, so anything that you're taking as a salary that you're giving to employees as a salary, again, they have to have source deductions on it, so your taxes that you're taking off, your CPP and your EI, not only for your employees, but for yourself, for your company. So the company has to pay those, the EI and the CPP as well.
So
say something about that?
For T4s and T5s, there are two things that you want to think about when it's or how it's affecting your reports. T4s, again, their salary, so they are decreasing your net profit for the year. Just some consideration as well when you use your reports for something other than your corporate taxes. For example, if you decide to pay yourself through salary, which you will eventually issue a T4 for, that means your net profit is going down. And if you are trying to apply for financing or a loan or something like that, that they would need your net incomes or your income statement. That could be a negative impact on your income statement, as opposed to a T5 where it is coming out directly from your retained earnings. So basically the function where you take out your money out of your corporation can be either way depending on what you declared at the end of the year. It's a matter of tax planning that would make you decide which one is better for your household specifically, because not every T4 and T5 mix would be applicable for every personal household or any personal tax.
Yeah. Right. And sort of to just follow up with what you said too. So T4s show up on your income statement. So the salaries are going to show up as an expense on your income statement, T5s, which are dividends, are going to show up on your balance sheet.
Exactly.
So that's kind of where you would see those in your reports.
And this one would be taken out of your retained earnings. So your statement of retained earnings or statement of deficit will be the one that would be affected by your dividend.
Right. Yeah. Good.
Okay. So the next question is, when do these T4 and T5 slips need to be filed?
Yeah, so even though they're different, they have different information on them. They're found in different places of your statements. They have to be filed at the same time. So they're all due by the end of February. So February 28th or February 29th, depending if it's a leap year, that's when they have to be filed with the CRA.
Are there any source deductions or payroll remittances for T5s?
No, T5s don't have any deductions, source deductions or payroll remittances. So you can declare them at the year end, whatever, and there's no issue with having to pay the tax on a regular basis like you do with the T4s.
Yeah. One major tip that we normally give our clients is, when you take out money through your corporation, doesn't matter if you think you're paying yourself salary or dividends, if you are issuing a check, please don't put salary on your memo, on the check, because it limits what your accountant will do at the end of the year when they try and kind of figure out what mix is necessary for your household. And again, it's very common practice to just declare salary, because it's the easiest way to declare something that was drawn out of the corporation. It also it looks like you're going to be paying taxes lower on the corporate side, but sometimes it doesn't actually take into consideration how much tax you'll be paying personally. So it's just one of those things that you want to figure out, and you want your accountant to have a little bit of flexibility on. So don't put anything on your check. If you need to withdraw money, just put shareholder draw.
Yeah. Good point.
What are the deadlines to submit payroll remittances CRA for T4 amounts?
Yeah, so submitting the payroll remittances to CRA, the majority of small businesses that have to pay source deductions, especially if you have employees, it's the 15th of the month following the pay date. So if you pay your employees in January, then the payroll deductions are due the 15th of February. And the payroll is based on a cash basis, so if the pay period was in December, but the employees got paid in January, CRA considers that a January time frame, and so then it has to be done in February.
Right.
Yeah, so they have to be done by the 15th of the following month.
There are some quarterly and annual remitters,
Right.
but they're very they're not very frequent,
Yeah.
and I find that it depends on how much you're remitting every month, and you'll be approved for the quarterly first, and you'll get a letter from CRA letting you know if you're eligible. But for the annual remitters, usually it's the ones that are just the owners as employees.
Right.
So that's something to think about as well.
And just small businesses, the majority, it's going to be monthly. Yeah. And if you do it monthly, you're not going to be wrong. Yeah, exactly. If you do it quarterly and you're supposed to do it monthly, then you're in trouble.
Yeah. Upon filing your T4s, how does CRA know if you've paid enough source deductions?
Yeah, so when you file your T4s in February, that's when the CRA takes a look at what you file and what you've actually paid. And so they're going to know whether or not you've paid enough source deductions. That's how they're going to figure it out.
It has to match your remittance. If it doesn't, you're gonna get a letter from CRA asking for the discrepancy.
That's right.
Description. So before you file that T4, make sure you locate that discrepancy, or you pay the difference in between. If CRA has concerns with these amounts, what sort of audit will be triggered? I guess.
Yeah, so
I got
that's
ahead of
gonna
myself.
trigger. It's okay. So it's going to trigger a payroll audit.
Yeah.
Yeah, and so like Yahweh said, they'll send you a letter first asking for the discrepancy. So you send that information in. If they're okay with that, like if you can explain that discrepancy, or if you've paid the difference, then you should be okay. If not, then you're going to get a payroll audit, and that's a lot more involved. They're going to ask you probably for your pay stubs, for PD7A reports, which show what source deductions you should have taken off. They're going to ask you for bank statements. They're going to scrutinize those bank statements and see what's happening with that money. They want to find out what happened to that money. Basically, they consider it trust funds, or trust money, so it doesn't really belong to you. So they want that money.
Yeah, absolutely. It's money you've taken out of your employee's paycheck that you withheld. So it's basically you holding on to that money until you're admitted to the CRA.
Yeah.
So same thing with GST. So that's why GST and payroll are usually penalized a little differently than the other taxes like corporate tax.
Yeah, exactly.
What are the two main functions that will happen in a payroll audit?
Yeah, so in a payroll audit, they're going to look at your bank statements and scrutinize those bank statements and find out where that money went, what happened, like why aren't you paying that? And they're also going to start looking at your other expenditures and find out like your personal expenses, how much was going to yourself, and just finding out again why you haven't paid those source deductions.
What are the two main things you can do to avoid a payroll audit?
Yeah, so of course the first thing, don't pay late. Pay your source deductions. And the other thing that you can do is make sure you pay the right amount of source deductions. You know, it's very easy to keep track. The CRA has a program that you can use to you put in the amount that you're paying your employee, and it shows you how much you can
have to deduct.
you have to deduct. And whatever software you use for your payroll should do it as well. I know QuickBooks does it. It tells you exactly how much you need to be paying. Just another tip, so you have to pay the employee's taxes, you have to pay their CPP, plus you have to pay employer CPP, and then that matches, and then you have to pay the employee EI, and you have to pay the employer EI, which is 1.4 times the amount, so a little bit more than what the employee pays.
Yeah, so, sorry, you just have to be careful as well with your TD1s. I've been to a lot of employers who doesn't actually give you a TD1 form, and normally they just assume that they're your only employer. For people who have two jobs, it's very important that you have your TD1, because those two employers will be sharing the credits that you report on there. So you want to make sure that you only report it on one side, and this is on the employee side, and for the employers to know as well that those TD1s are really what they use to calculate how much credits they have to remove at the end of the year, and how much tax from that will have to be deducted from the employee's paycheck.
Right. Yeah, and sometimes on those two, sometimes your employees want to take off a bit more tax, so that they're not paying at the end of the year when they do their personal taxes.
Yeah, absolutely.
Yeah.
Why should you assess personal benefits prior to a payroll audit?
Yeah, so when you get a payroll audit, that's what the CRA is going to look at. They're going to look at your personal assets, your personal benefits, and again, just make sure that you're not taking that money that really belongs to the CRA, and that was supposed to be paid on behalf of your employees.
Yeah. So I think that's all the questions we have today. I hope you find it informative, and if you have any questions or ideas that you want us to talk about regarding Edmonton bookkeeping, let us know in the comments below, and please like and subscribe on our page, and we'll see you guys next time on our next episode of Always Up to Date.